Hello, everybody. My name is Nicole Elliott, and I'm a technical analyst and private investor. And I just wanted to warn you that with Thanksgiving tomorrow, which marks very much the beginning of the holiday season for so many people all over the world, it's not just Thanksgiving and it's not just Christmas, it's Hanukkah and all sorts as well, and New Year. So thin markets, be very, very careful, and don't think yourself too clever if you've got a few things right. I mean, I was particularly shocked when President Trump comes out for a literally 1 minute comment at the White House press briefing room, where he says, I just wanted to congratulate everybody. Never before has the 30,000 mark on the Dow been broken. That's a sacred number. I mean, really? I mean, what sort of, listen, leave this holiday season alone, have as much fun as you possibly can and be careful. But this sort of comment is really unhelpful. So, steering well clear of US equity markets, I thought I'd look at currencies again today. I know I did them a fortnight ago for you, and I looked at some majors, but today I'm going to have a slightly different longer term view. My first chart is a quarterly chart of the value of the US dollar index. This is the basket of major currencies valued against the US dollar. And I bet very, very few of you have charts going back to 1974. This is courtesy of Reuters data stream Refinitiv. And this gives a far better sense of perspective. And it warns you not to listen to all the media hype. The proliferation of words like collapse, catastrophe, zooming, booming, ballooning. I mean, it's just ridiculous. So this quarterly chart, you can see that the dollar index has traded at a level between 90 and the psychological level of 100 for the last 6 years. Nothing new under the sun. What is interesting here, though, is you can see that yet again, we have retreated from that secular trendline resistance that started in the mid-80s. We're pushing down towards the 90 support level. But what's more important is that rarely since 1986 has the US dollar index traded above 105. That's a horizontal resistance level, and the Fibonacci retracement, 38% are marked on there. My hunch is that we're going to break below support next year, and that we'll move on down towards the 80 level, which is towards some of the cheapest levels that we've ever seen since exchange rates were freely traded. My second chart is a monthly chart of the euro. Now, the euro hasn't been going so long. It was issued in, what was it, January 99, I think. And that too has been trading at some of the lower, weakest levels since inception. Not the lowest ever, but down around there. So cheap. I've drawn in a standard deviation with a mean regression at the middle, and you can see that we struggled with that regression level in 2017, early 2018. On the other hand, one standard deviation below the mean has actually supported prices since 2015, mirroring the action on the dollar index. We're struggling here once again at trendline resistance, but I think we will eventually break it. My third and final chart is a weekly chart of the Canadian dollar, quoted as Canada per US. It's probably one you're not familiar with. Every aspect on this Ichimoku chart system suggests that we're going to break below 1.29 Canada per US, and that the Canadian dollar too will strengthen against its American counterpart with a target of 1.20 sometime next year. Good luck, everybody, and happy Thanksgiving.